If you want to understand what institutions are actually doing on your charts, I want your full attention, because what I'm about to show you has been hiding in plain sight on every single chart you have ever looked at. We are not going to talk about lagging indicators. We are not going to talk about candlestick patterns. What I am about to show you is how to read exactly what institutions are doing inside consolidation zones. And I will be showing you 5 years of gold data to prove it. If you trade gold, you do not want to miss this. But first, let me ask you one very simple question. Have you ever thought about what time frame institutions are actually using when they buy and sell? One of their most important time frames is the 4-hour. And once you see what they are doing inside these ranges, you will never look at a consolidation zone the same way again. Most traders have a strategy for trending markets, but very few have a strategy for what happens in between. Here are the facts. Once you know what trading conditions you are in, you can plan your entire trading day accordingly. I have already covered uptrends and downtrends in previous videos, but consolidation is where most traders get destroyed. Because when price is stuck in a range, one question matters more than anything else. Where is price going next? And more importantly, will you be trading with institutions or will you become their liquidity? Before I show you the examples, you need to understand how these levels are created. The tool I use is the fixed range volume profile. I place it over consolidation zone where price has been ranging. For the settings, I use 128 for row size and 70% value area volume. This allows us to identify where the majority of volume was traded within this range. Next, you have your 3 key levels. You have our fixed value area high, our fixed POC. This is where the highest amount of volume was traded within this range. And we have our fixed value area low. Together, these levels show us where the highest concentration of trading activity took place during consolidation. So now the question becomes, when price returns to these levels, who is in control? Now, look at this example. Price had been in this range for about 2 weeks. Eventually, price breaks to the upside. Now watch what happens next. Price comes back into our range and you can see the reaction from our fixed value area high. Now look at that rejection, and then price continues to go higher. This is what I want you to focus on. Price breaks the range, price returns to the range, and institutions defend their position. When you combine volume with price action, you start seeing the same story over and over again. Now, this example is just as important as the previous one. Price broke out of this range, but when price comes back to the fixed value area high, it slices straight through it, and that tells you something critical. When price cannot hold the fixed value area high, that level flips. It stops being support and becomes resistance. This is not a failed setup. This is the market giving you information. The reaction is the information. And once price starts trading between these zones, you are in a completely different trading environment. And one final example. Price breaks down aggressively from the range. And at first glance, it looks like the move is over. But watch what happens when price returns. it comes straight back into the area where institutions had been positioning themselves. And look at that reaction and those rejections. These are not random candles. These are not random turning points. This is institutions defending a level they considered important. And the evidence is right there in front of us. Different market, same story. Now, before I show you gold data, I want to explain why normally you see consolidation for summer months. One reason is lower institutional participation. Summer is a major holiday period across Europe and America. So many hedge fund managers and bank traders take extended leave. But that often means lower participation. And lower participation can lead to lower conviction. Another reason is that institutions are often waiting for major economic events. Things like the Fed meetings, ECB decisions, and inflation data. So instead of committing large amounts of capital, they build positions and they wait. Now, nothing in the markets is guaranteed. This isn't a prediction. It's simply understanding the market context. And with that in mind, let's look at what happened in gold over a 5-year period. Now, watch what happens here. Price spends more than 1 month inside this consolidation zone. Nothing special, just buyers and sellers fighting for control. But eventually, price breaks lower. And this is the part most traders miss. When price comes back into the range, it finds sellers almost immediately at the fixed value area low. And look at those rejections. That is not random. That is the market telling you sellers are still in control. That range broke lower, price came back, sellers defended the level, and price continued lower. Once you understand that relationship, consolidation zones stop looking like noise and start looking like information. Now look at gold in 2021. Different year, different market conditions, same story. Price spends weeks building a consolidation range, and eventually price breaks lower. But watch what happens when price comes back. Look at those rejections from our fixed POC and fixed value area low. Those levels don't get ignored. They get defended. And when key levels get defended, price usually tells you who is in control. And again, this isn't prediction. This is evidence. Now, this consolidation zone is much smaller. The story is exactly the same. Price pushes up above our fixed value area low. It pushes above the fixed POC. And it even tests the fixed value area high. But look closely. They cannot defend the fixed value area high. And that is the first warning sign. Then price moves lower. And once price breaks below the fixed value area low, the market gives us our answer. Sellers are now in control. Again, different chart, different year, same behavior. Now this is where things get interesting. This consolidation zone lasted more than a month, and eventually price breaks lower. So at first glance, it looks bearish. And when price comes back into our range, it gets rejected from our fixed value area high, which makes it look like sellers are still in control. But watch closely. Price never goes past the fixed value area low. In fact, buyers keep defending it, and that changes everything. Once we go past the fixed value area high, the question now is whether the fixed value area high can hold if price comes back again. And when price comes back for a second test, look what happens. Sharp rejection, strong momentum, and a powerful move to the upside. That is why one reaction is never enough. You need to see who is defending the levels, and more importantly, who stops defending them. Now let's look at gold in 2024. And at this point, the pattern should look familiar. Price spends weeks consolidating inside the range, and eventually price breaks out. But what stands out to me is what happens next. Price never comes back. It launches from our fixed POC and it never looks back again before continuing to make new all-time highs. There is a very specific reason why that happened. A reason I will be covering in my next video. So if you want to understand why institutions were willing to be so aggressive here, make sure you are subscribed. Because once you understand that piece of the puzzle, these moves start making a lot more sense. If you have made it this far, you are probably asking one question. What do I do next? And the answer is simple. Go and test this for yourself. Open up Fixed Range Volume Profile on TradingView. It is free. Use the settings I showed you earlier and then go through your charts. Gold, Forex, Indies, whatever market you trade. And look at what happens when price comes back to these levels. Look at the reactions and look at who is defending them. Because once you start seeing that, you can't unsee it. And yes, these concepts can be applied across multiple time frames. This is a 30-minute Euro New Zealand dollar chart. Price breaks above the range, comes back to the fixed value area high. Buyers defend it once, then they defend it again. The question was never where would price go. The question was who was defending the level. And once you start asking that question, the market starts revealing things most traders never notice. So if you want to understand what might happen in the future, you need to understand what happened in the past. And if you have any questions about anything you have seen in this video, leave them in the comments. I read every single one. And I will see you guys in the next one.